I would like to welcome all of you to our joint regional event with BNP Paribas on behalf of the French-Hungarian Chamber of Commerce and Industry. Let me introduce myself. My name is Monika Bacska-Juska, Head of Communication of the French-Hungarian Chambers. Our topic today will be the implications of the coronavirus for Central and Eastern Europe. And especially I would like to thank to our cooperating partners, the regional French Chambers of Commerce and Industry in Bulgaria, Czech Republic, Poland, Romania, Serbia, and Slovakia. I would like to share some technical information also with you concerning today's program. So after the introduction, our speaker, Mr. Michal Dibula, will have his presentation. And after we will let you the possibility to share your thoughts and ask your questions. So I would like to ask you to write your questions or thoughts to the chat forum, or there is a Q&A forum also that you can see on the right side. And now I would like to pass the word to Björn Clausen, Regional Head of Multinational Coverage Central Europe of BNP Paribas, to give his opening speech. Please, Björn.
Yes, thank you very much, Monika, for handing over to me. Dear clients, dear partners, dear guests, a warm welcome on behalf of BNP Paribas. And it's a pleasure for me to be here. And it's a great way that we, with this call, bring Central Eastern Europe closer together. As mentioned by Monika, 7 French chambers are involved, and on the other side, 10 countries in Central Europe have been invited, in which BNP Paribas is active. So this is, I think, a fantastic way to bring our region closer together. Michal Dibula, our speaker today, is not only the chief economist for Central Eastern Europe, he also, and as I can tell you very clearly, loves the country and is very, very close to all of these countries. He will give an insight into the nature of the crisis, coronavirus, what does it mean, and he will also give us a view on the possible scenarios, the consumer and corporate behavior, but most importantly, he will focus on Central Europe. So feel welcome and let's enjoy the presentation. Michal, the floor is yours.
Thank you very much, Björn. Ladies and gentlemen, it's a great pleasure being together with you. I hope that as soon as possible we can meet in person and talk in person to each other, and that will be, of course, then a great indication that the crisis, that the virus is over. So I'm really hoping for that this will come true very quickly. That's at least my hope. I will now try to upload my slides and then go straight away to the presentation, to the main points. I think as this has been already said, please do ask questions, do write them down. I can see them and will try to respond to those as much as I can. I think the coronavirus, the corona crisis by itself is something of a different dog for the economists, because if we look at the key drivers, at the emergence of this crisis, we have to truly confirm and say that this is a different type of anything of a recession that we have seen so far in the 21st century. The first, I think, very important point, it is not really a kind of man-made crisis. It is not the function or the result of badly functioning institutions, especially financial ones. If we go back to the global financial crisis, there it was the financial sector really driving the global economy into big mess. This is not the case right now. What is perhaps more true is that the crisis and its global spread is more of a function of the way we live, of the way we work in an increasingly globalized environment and an increasingly globalized economy and world. So that's something truly different. Another distinctive difference compared to what we have seen so far is that I guess this crisis is not really impacting the demand side of the economy. It is at the same time also a supply side crisis. Think about the impairment of several logistics and global value chains. Things like lockdowns that do really bite into the production side of the economy and reduce the possibilities to produce output. So that's certainly a different thing, and that's certainly something also of an intellectual challenge, how to see things moving forward right now, because to be fair, I mean, we haven't seen such a crisis not in the latest history. Coming perhaps to the responses, how to deal with that. I guess one thing is very optimistic, or one thing is giving the hope that things can improve in a more sustainable way and relatively quickly is the fact that if you look at policymakers all around the globe, it seems that the response to the crisis has been much faster than what we have seen during the years 2008, 2009, or in the double-dip recession in Europe in 2012. Now it seems that policymakers have been acting much faster, but also in a much more coordinated fashion. Call it as that. So we not only have interest rate cuts, we not only have quantitative easing or asset purchases all around the globe, basically, not only in the major economies, but also in our countries, also in other emerging marketplaces. And we also have, and that to my mind is also a very positive sign. We also have ideas on the European Union level to provide the necessary funding for the economies to get out of the mess relatively quickly. So this Merkel-Macron plan, then dubbed into the European Commission proposal, is 750 billion euro for the years 2021, 2024. That's really a lot of money. And if you think that the efforts of central banks in the previous crisis were not really successful in boosting the economy, perhaps the reason why that was the case is that we had at the same time relatively austere, relatively tight fiscal policy. Now that's not the case, and that, to my mind, is giving more hope for things to pan out better. Having said that, of course, the situation is still pretty much fluid. We know that the second quarter and the month of April were particularly bad in terms of the economic fallout. May and presumably June are much better. But we still don't know how the situation will truly evolve after this quarter is over. We may have a second wave of the epidemics coming back. We may have events like fallout of certain institutionally important players because of the COVID crisis, not only in the financial sector, but presumably more likely in the real economy. So still something that can put us a little bit off track. So therefore, this kind of various scenarios are still possible, and I think that making a kind of a number forecast for growth, for activity at this stage is really difficult. It's much more difficult than this was the case in the previous recession. I guess another thing that is important to highlight, and you certainly in your daily business can, I'm pretty sure you can feel and sense it, is that consumer behavior has been also changing. Of course, if there is a pandemic and you are forced to stay at home, you naturally do focus more on healthcare, on these sort of issues, whereas certain type of activities, certain types of consumer spending are either not available or are simply ditched because they are not deemed to be really essential in a period of crisis or in a period of uncertainty. And on that point, I think that these or at least some of these consumer behavior changes can really prove more permanent. So even if the crisis is tackled, if we have either effective vaccination or medicine against the COVID, certain things may stay with us for a little bit longer. The same applies for the way we work, and talking with our corporate clients here in Poland, talking about working from home, talking about holding meetings like we have it right now through video conferences is something that is likely to stay with us even when the virus is gone, and that's certainly something that will also be impacting corporate spending, consumer spending, and the way we move forward. I guess in terms of particular sectors and the economies. Again, I mean, a lot of things are still a wild guess, but if we would assume that certain consumer habits are truly changed, it's relatively easy to pinpoint the losers and also the winners of this new normality or new reality after the COVID. We all will need more viable means of doing things remotely via the internet. That's a big opportunity for e-commerce. That's a big opportunity for IT solutions providers. And these type of businesses will certainly be flourishing, alike the pharma industry, alike certain parts of chemicals, alike packaging industries as e-commerce. You know that very well, presumably buying quite a lot of stuff from home right now. The packaging content is just overwhelmingly huge compared to what we see if we do just normal shopping in a place around the corner. I guess another thing that is going to be very important is that we may see quite a lot of tectonic shifts, or call it creative destructions within the corporate sector in different industries, because as in any type of a crisis, and that we as economists are relatively certain is likely to happen, that market concentration is likely to increase. We're gonna have the financially weaker companies either disappearing or being bought by more successful or financially stronger competitors. So M&A activity is likely to accelerate quite a lot. I will have a slide on that in a second. And finally and lastly, I guess what is perhaps of the biggest importance is how to deal with the implications of the crisis and the métier of social and economic and fiscal policy. We know that a lot of fiscal money has been pumped into the economy, so public debt ratios, public debt levels will increase, and the question is how to move forward with that. Is that Japanification scenario where public debt to GDP is more than 200% of GDP, whereby the bulk of that is being held by the Bank of Japan? Is that really the only way forward or the only way out of this crisis, or can we still see some other measures being implemented by policymakers? Think about different tax policies. Think about putting it in plain words, taxing the rich, taxing the assets, just in order to have the means, first of all, to reduce the debt burden, and eventually to spur more income redistribution. Because as something that I would believe is relatively certain due to the COVID is this further acceleration of robotization in production processes, especially in manufacturing, and of course the massive digitalization of the service sector. So that all is going to mean that demand for labor, particularly the less skilled one, is likely to decrease. So I think, irrespective how the crisis is going to be panning out within the next couple of months, the changes are likely to be quite far-reaching, both on the consumer side and on the corporate side. Perhaps to finally conclude on my introduction, is that the crisis, like any sort of a change in the status quo, is of course creating numerous risks. Some of them I have already mentioned, but it is also creating opportunities, and that is particularly relevant, I think, from the overall European perspective, but for our region, for Central and Eastern Europe in particular, because if you think that the fear of another virus or the mutation of COVID, and the fear and the risk of some regional lockdowns in production and service activities, may be leading corporates to the conclusion that having very sophisticated, very large and efficient value and logistics chains may be a very risky strategy moving forward. So perhaps it makes more sense to replace suppliers from other continents, at least where it goes, with companies that are closer by, that are in Europe. And I think, again, talking to our corporate clients here in Warsaw, that's something they are emphasizing, that their supply and logistics chains are likely to be streamlined, bringing things a bit closer to home, if I can say like that. Of course, creating some additional costs, at least at the beginning, but simply striving for the business, for the institution, for the company to be perhaps a little bit less efficient, but to be much more robust and less prone to situations like we have been observing, particularly in March and April, where certain supply chains have been disrupted. As I was mentioning at the beginning, well, we have different type of economic outcomes. We know Q2 is going to be pretty bad, but what happens afterwards is still pretty much uncertain. Here's just an example for Poland, but you can look at that as a more general example, that we have at least four possible scenarios for growth, for economic activity moving forward. We may just certainly have a kind of continuation of the rebound of the recovery that we already see in May and June in the next coming quarter. So that will be, of course, the best case scenario, the V-shaped, relatively brisk recovery, GDP levels coming back to the pre-virus stance relatively quickly, say middle of next year. Would be still possible, but of course we may have either kind of slower pace of recovery, this upswing fading at some stages, or we may have even a kind of double dip disappointment, especially should there be another wave of a more deadly or more dangerous mutation of the crisis. So that you can see will be creating a totally different perspective for the macroeconomy, but certainly also for businesses. And when I said at the beginning that this forecasting this crisis, forecasting the variables is very difficult for economists at this stage. I think the only way we can deal with that is in a more sensible way, is to is to think about really alternative scenarios, different scenarios of how the situation may be panning out, and trying to find the relevant recommendations or strategies of how to run a business or how to run economic policy in this different circumstances. As I mentioned at the beginning, this consumer behavior and habits, the change of that, I guess we are already starting to see that, and at least the kind of Polish data, we have them relatively early, so we already have the numbers for May, are indeed confirming the kind of pre-virus expectations, or the expectations from March, that people will be spending much less on non-essential items, non-essential goods and services. Think about clothing, footwear, partially also hit by the supply side constraint, but also because of demand, because of the fear of less income or less income growth, because of the fear of higher unemployment. Consumer durables are, of course, very much negatively affected by this crisis, at the expense of things like pharmaceuticals, and in the case of Poland, which I found quite surprising, by greater consumption of tobacco and alcohol. But that's at least what the data are saying. So here's some few ideas about how this consumer structure may be changing. Certainly much less spending on non-essentials, but much more spending on things that may be necessary in the crisis. Think about IT services, communication, working from home. All that is going to be creating additional demand, irrespective of a more constrained or income constrained consumer. Think about health, not only in terms of pharmaceuticals, but also in terms of additional private insurance on health. That is also something a bit more of an anecdotal evidence, perhaps, but this is something that I have heard from some Polish clients as well. I think those changes may be also affecting really the kind of very detailed spending categories. Of course, restaurants, accommodation, that's being very much hit and is very unlikely to come back to pre-virus levels, at least this year. But certainly all this kind of services like catering, for example, that has been flourishing and seems to be doing fine, even when people start to slowly move back to offices. That type of catering services are still pretty much in demand. We're talking about sectors, talking about particular industries. I guess what is necessary to think about is that it's not only one industry that is being hit or two industries that are being hit. It's a whole value chain that usually is either hit or is benefiting from the COVID changes. So therefore, I think that is very important to look at your buyers or consumers, but also to look at your suppliers, because they may be feeling either downside pressures or maybe taking some extra demand because of the new situation. So I think that this is very important to understand that it's not standalone industries that are hit or are benefiting from the situation. It's a whole logistics chains in a particular type of production of goods or provision of services. Here, the value chains in the international context. As I said at the beginning, I mean, the companies that I have been speaking to are really trying to streamline these chains, and wherever something is a bit more remote, more uncertain, and perhaps a bit more prone to an unexpected regional lockdown or unexpected regional virus, is being tried to be streamlined, with suppliers being brought closer to home, and I guess in our context that is very very important to stress. Central and Eastern Europe is certainly good positioned in this towards this potential change. We have strong industrial bases in our countries. We can produce goods of high quality and still relatively cheaply. So that is certainly a trend if continued, from which we can benefit as economies, as businesses here in the region. Will everybody benefit from that? Well, certainly not. The kind of illiquid companies will be facing troubles like in any sort of a crisis. Partially, they will simply disappear from the market. Partially, they will merge with financially stronger competitors, especially those companies that want to increase their market shares. That doesn't necessarily have to be competitors. It could be other companies, other firms from the same or similar type of industry, or suppliers, or buyers of certain goods. So these sort of vertical and horizontal integrations are likely to be forthcoming. I can sense it from talking to my colleagues here in the bank in Warsaw that this activity is really gaining pace right now, and is likely to be a theme for corporate bankers, but also certainly for companies for the next several months at least. So I guess that this, in a kind of very general outset, would be very important to highlight, especially that I don't really know the kind of dispersion between the strong and weak companies in all the Central European economies. But looking at Poland, looking at our 615 odd different type of industries, when I look at each of them, I see that these differences in the financial strength of companies in a certain industry are really huge. So if you think about liquidity, if you think about debt ratios, if you think about profitability, the strongest 20% compared to the weakest 20% of companies, I mean that's just a huge difference. And as we have seen that in Poland, actually this dispersion, this difference has been rising. So that certainly does even more strengthen my expectations that this M&As, but also insolvencies will be likely forthcoming. To conclude on the more general remarks, I think what is necessary to see where we are right now in terms of our economies, in terms of the global economy, in terms of global markets, what is being priced in there, and how do investors see the situation moving forward? Because I guess a couple of things are very important to highlight at this stage. Let me start with the upper chart, the composite PMI, so both manufacturing and services, three major economies, US, China, and Eurozone. It seems we are back, well, at least close to the kind of expansion. So recession, however deep it was in April, is getting less severe. And I think that looking at again the Polish data, we have them already pretty detailed numbers for the month of May. This is really happening. Economic activity is bouncing back, basically in all the aspects, on the side of consumption and on the side of production, and that's very important, and certainly encouraging that the fallout doesn't continue, and or that any sort of bounce back is just very shallow. It doesn't feel like that. Perhaps to raise the attention to the bottom slide here, the post global financial crisis, global growth environment, and central banks policies. Again, the three main central banks, the Fed, the ECB, and the Bank of Japan, and their QE policies, so basically the balance sheet policies. They seem to have been certainly much more telling about what is going on in the global economy than just pure interest rate moves. Anytime central banks were QEing in this past 10 years or so, global growth tended to accelerate with a certain lag, and vice versa. Anytime the QE processes have been stopped or unwound, the global economy started to feel the pain of this tightening. So looking at the latest central banks' decisions, at the kind of renewed expansion of their balance sheets, that should tell us that again, I mean, however deep the recession in 2020 is going to be, 2021 should post a relatively strong and robust recovery, especially that this QE is not only buying the stuff that is already on the market, but that it is additionally topped with more softening of the fiscal stance, with greater public expenditures. And that, as I said, I mean, gives a bit more hope for greater sustainability of this recovery. And that's, in essence, I think what markets are currently pricing. The left-hand upper chart with the DAX and S&P 500. Well, that's a V shape. I mean, if anything else, we are back or close, very close to the pre-virus levels in terms of equity valuations. And that you may say, yeah, but equity markets are notoriously volatile. That can still change. Of course, that can still change. But what I think is very encouraging at this market juncture is that it's not really only the equity market that is benefiting. If you look at the right-hand column and the middle chart, it shows gold and copper prices. And here I think especially copper is very important, because that is also being mimicked by the other industrial metals. Their prices are moving up. I would not like to say like hell, but they are really rising very, very quickly, and they are normally associated with strong global investment demand that is forthcoming, and that, to my mind, is at least at this stage vindicating the expectations for this V-shape or robust and swift recovery scenario moving forward. I guess that this is also pretty much visible in the indicators for the U.S. and the Eurozone. Well, Q2 is going to be bad, but this easing of the fiscal and monetary stance gives us a bit more hope for things improving relatively swiftly. Perhaps one slide or one chart that I would raise the attention to, it's the lower left-hand slide with the U.S. swaps, the 2s and 10s. Of course, moving lower because of the Fed cutting rates effectively to zero. But what I think has been encouraging since then is that the swap curve did steepen quite a lot. And if you think about how the shape of swap or bond curves has been leading economic growth expectations, that's certainly again another sign for investors' optimism that the coronavirus is going to be over and will not have really this kind of long-term ramifications in the form of another double-dip recession coming relatively quickly. So I think that this is very very important. I have in terms of the Central European countries, and so please forgive me that I don't have Serbia and Bulgaria, but we are not covering those economies here out of Warsaw. So I have only Poland, Hungary, Czech Republic, and Romania. But I think those slides may be offering also some guidance for the other Central European economies, how the situation is looking like, what are the various and different policymakers' responses. So starting with Poland, economic sentiment, of course, pretty much in the doldrums. Poland will see the first proper recession after 1991. So that's already nearly 30 years. 30 years ago, that during the transition period from communism to market economy, all the countries that face contraction in output, Poland as well. But since then, Poland was always somehow immune to all the kind of global turbulences. Even if growth was slowing down, that was zero-ish at worst. But now, of course, the situation is much more different. We see that in the high-frequency activity data on retail sales, on manufacturing, to the least extent on construction, but certainly on services. We will be seeing a recession this year. But how deep it's going to be? Well, we, for the moment, are looking for something like a 3% drop. That puts us, I think, at the top of the forecasters' range at this stage. Other institutions, including the European Commission, the IMF, not to mention the OECD, which is very bearish, very bleak forecast from those guys. They are seeing a much bigger pace of contraction this year. But when I look at the second quarter data, when I look at the pace of recovery that we have seen so far, I'm relatively confident that the 3% recession is still a valid case. We will not necessarily need to contract by more. What is certainly helpful, perhaps I will skip a little bit, the inflation chart. It's going to be looking the same in the other economies, but saying perhaps a few words about the policy actions that are raising my optimism for this Polish recession to be relatively short-lived. We're going to have a very substantial widening of the fiscal deficit to 9% of GDP this year, partly because of the recession itself and the loss in revenues, but partly because the government has very quickly endorsed a pretty substantial fiscal package. Quite a lot of stuff coming in guarantees, but a lot of the program being focused on spending, and that, as we know, is usually in a kind of crisis period quite efficient. On top of that, central bank cutting rates, well, basically to zero and starting to QE. If we assume that the fiscal deficit is going to be around 200 billion zlotys this year, that's effectively also our expectations for the amount of assets being bought by the central bank. They currently bought something like 95 billion, so still more than a half to go in the next couple of months, stabilizing the long end of the curve and helping things moving forward. So on that side, I think this a very swift and robust and decisive, and as it looks, coordinated policy response is giving us a bit more hope for the recovery to commence. The situation in Hungary, different economy, of course, different economy in that sense that if you consider Poland, it's one of the least open economies in the region. Exports and imports combined in relation to GDP, that's around 100, perhaps 110%. In the case of Hungary, where exports by itself is effectively close to 100% of GDP, this openness is at least twice as big. So therefore, given the kind of international context of this crisis as well, I personally think the pace of recession in Hungary will be much deeper. We are forecasting a fall in GDP to the tune of 5%, and I have to say, again, we are probably somewhere in the middle of the range of the forecasting community. We are more optimistic than the OECD. But we are certainly not as optimistic as the central bank, which has been yesterday publishing its economic growth forecast for the country. And surprise, surprise, they do not expect a recession at all. They do still expect a positive growth to the tune of somewhere between 0 to 2% this year. I personally think that this is way too optimistic, even in the kind of best case scenario. That's pretty much unlikely to happen, especially that so far so good. The response in terms of fiscal and monetary was relatively muted. The measures that the government has announced are pretty large. That's 20% of GDP, but most of that is loans and guarantees without this kind of direct fiscal stimulus pass through into the real economy. That's, I think, also nicely reflected by the forecast of the European Commission for the Hungarian general government deficit, which is seen at around 5% of GDP. Compare that to Poland, 9% of GDP. Totally different situation. In terms of the monetary policy, what we have seen is a bit more of paradoxical moves at the early stages of COVID. The central bank was effectively tightening the monetary policy to bring back a bit more stability in the forint. Once this has been achieved, this week they have been cutting interest rates, and we believe there is still more room to go. Why there is still more room to go? Because most likely inflation is going to be falling relatively quickly below the target, at least on the core measure. And that, as we do believe, as we understand the currency fundamentals, should be eventually conducive for the euro rate to stabilize as well. Interesting thing in the Czech Republic, in contrast to Hungary, which is from its structure a very similar economy. I mean, also Czech Republic, Hungary, very open economies, foreign trade in relation to GDP close to 200%, very much skewed towards the European market and the automotive industry, and totally different expectations on the policymaker side. Here again, perhaps the European Commission, OECD forecast pretty much bleak. But what I think is really important to stress is that the central bank in the Czech Republic is looking for contraction in the real GDP to the tune of 8%. Compare that, -8 in the Czech Republic to something like on average +1 in Hungary. I don't want to really elaborate too much on the communication strategies of central banks, but I think at least it shows the kind of huge uncertainty even among policymakers of how things will be panning out. For the Czech Republic, we are a bit more optimistic than the central bank. We do believe recovery will be forthcoming a little bit faster than assumed, especially that what the central bank could do and has done is to soften monetary policy very much. Interest rates close to the zero bound right now. Currency much weaker, and perhaps the most important news that was forthcoming in the past months is that the government has also decided to loosen up the fiscal belt. If there is a country in the region that has ample fiscal space to go, it is certainly the Czech Republic, with debt levels or debt ratios versus GDP below 40%, and so prudent or very prudent fiscal policy. In the previous years, they have this fiscal space. They should use it. Ultimately, they came to the conclusion that they should do that, and therefore, I think the perspective or prospects for the Czech economy are not as bad as the central bank has been forecasting a couple of weeks ago. Finally and lastly, Romania. We are looking for something very similar in terms of this year's performance, -5. Also well highlighted by the leading indicators. We are seeing a huge drop in economic activity, and perhaps the most sobering thing is that if you compare Romania with the other countries in the region, is that even in the run-up to the crisis, fiscal policy was pretty much stressed. Romania had a general government deficit of close to 4% of GDP, boosting this previous growth pattern, but also resulting in a huge trade deficit compared to the other countries in the region, which is of course limiting the policymakers' space. Central bank cutting rates. That's not a surprise in light of recession. That's not a surprise in light of falling inflation. But it's only as much as they can do or as they can achieve with cutting interest rates, without the possibility really to loosen up the fiscal belt. I think the recovery process may take a little bit longer, but that once again, as to highlight, is a bit more of a legacy of previous fiscal excesses. The fact that the fiscal space has been shut in Romania in the previous years is simply tying the government's hands to deliver something bit more robust. On that note, I would perhaps conclude with one final comment. I think for the region by itself, the recession may not prove as bad as it has been initially thought. I think in the medium-term perspective, all these countries do have the chances to come out stronger of this crisis, to strengthen their ties within Europe, to strengthen their corporate sector. But the pace at which they will be recovering may depend simply on the space policymakers have created themselves before the COVID. So all the countries that have been running more robust policies, both on the fiscal and the monetary side, those economies that could be cutting rates, those economies that could be delivering substantial fiscal stimulus, I would reckon will be doing much better, in the sense that the recovery process will take less time and will be probably much more robust. So thank you very much for your attention, and looking forward to your questions.
Thank you, Michal, for this interesting and wide presentation. Now I would like to ask you, Michal, to go to the Q&A forum, because you have 4 questions.
I'm seeing really questions.
Now 5. Now 5. We have 5. Yeah.
Okay, I start with the question on Poland and the big difference, fallback between average European economy and Poland. I think it's general 2 things. First of all, less exposure to trade, and certainly another thing that is also more relevant for all the Central European economies. We simply have a much smaller content of services in terms of GDP creation. So if you think about the lockdowns, if you think about the fact that especially human-facing activities must have been shut down for a certain period, that simply will provide that the kind of statistical effect of the recession on overall GDP will be smaller than in, say, Western Europe, or in countries that are, for instance, heavily relying on tourism revenues to break even. I mean, there the situation may be certainly much worse than in Central and Eastern Europe, as well as Poland in particular, because we are less open. Farmer sales are still much lower than has been already by the dramatic sales, and last week was the first time when sales slowly increased. That's relating to figures that, well, I cannot comprehend because I don't have this data set. What I have been looking at are the numbers from the Polish Statistical Office, and there you see that production and also consumption of pharma stuff has been increasing. On that note, what I think is very important to stress is that there are always differences in terms of the data, and sometimes, or I would not say sometimes, but very often I'm getting this question that you see something else that we microeconomists are seeing by the numbers or from the numbers from statistical offices. The numbers from the Polish Statistical Office are showing that that the situation in the pharma industry is improving. Pre-online services increased since the beginning. Would it be sustainable even after the COVID period? I think from a business model perspective, probably not. But if you can recall the kind of mobile phoning at its early stages, that's what normally firms are doing, just to create their market share, just to create the clients they will be then selling for higher price the services they are offer. Natural origin crisis will reveal human origin. Hidden crisis, huge debts, too much money injected over the past years without the expected effect, ethnic tensions accelerating by raising unemployment. I think that's absolutely correct in the way that the COVID crisis may be just the kind of story of today. Forgive my cynicism about that, but if you think about the problems the world by itself is facing, and here I would certainly add the climate crisis on top of that, which is perhaps even more important because it's aggravating or accelerating the other problems that we are facing in terms of migration, in terms of unemployment, in terms of food prices and so forth, in terms of wars for water, for instance. I mean, that's something that is happening. Is certainly much more serious in a couple of years perspective than the COVID by itself. But what I think is very important, and perhaps we don't have an answer to that yet, is that if whether this crisis will actually strengthen our integration efforts or try the attempt to tackle global problems on a global scale with global solutions, rather than to disintegrate ourselves each other, because then facing this truly important crises will be much more different. Home furnishings will be one of the losers. New norms for white collar jobs will invest partially there. That's something that we are seeing about home furnishings, furniture, and also to a certain extent electrical appliances like refrigerators and washing machines. But if I may distinguish two effects, the kind of short-term effect, because people will have to refurbish their homes to the ones that can to create some sort of a quasi office space. That's happening. But is that going to be sustainable? I mean, think about the kind of income elasticity on spending on different goods and services. And here, furniture is one of the relatively strongly impacted by income evolution services. So if we do expect that in response to the crisis, even if there will be a recovery, the labor markets will be looking a bit more stretched for a longer period of time. That income growth will be slower than it would be otherwise. This, I think, in the medium term will create rather downside risk for this industry or for the sector than upside risk, because people will be refurbishing their homes. Once they do it, it's done, and perhaps the next years will be less good for this sector than they would be otherwise, simply because income growth will be softer. That's at least how I would read this situation at the moment. Not just okay. What are the downside risks around the COVID crisis? I think the downside risks, there are quite a lot of them, and they may be not symmetric in the sense. I mean, we will see a lot of or the number of insolvencies, the number of bankruptcies rising. It's quite obvious that the financially weaker companies will most likely disappear unless they will be bought by someone else, and that's gonna be a risk. That's gonna be something a bit more lasting. Think about corporates, think about enterprises that are building their competitive advantage because of, for instance, cheap labor. I mean, that's slowly disappearing from our region if I can look through in the data. But this still is still the case, and if you consider that market concentration will progress, will create even bigger companies on different markets. Those companies are much more prone to invest in high technology, are much more prone to invest in robots and digital solutions. Then if one firm is still relying on cheap labor as a competitive advantage, will simply not be able to do so in the future because the prices of production in an automated way or providing of services in a digitalized way will be much cheaper than human labor. So that's something that I would see as a potential risk or a huge risk for companies also here in our region. Another downside risk. Well, I mean, politically, we may still not know how that situation will pan out. Probably coming back to the first question that I see, resources are getting scarcer, and that by all chances is always creating the desire to protect them and eventually not to share them at a reasonable price. So that's another sort of risk. Property market developing, e.g. in Hungary. I think on the market by itself is going to be facing again this kind of asymmetric responses. I mean, think about office spaces. If more and more people are working from home, what's the point in building new office spaces and filling the existing ones? So prices of rent will be going down, and I think the construction of these premises will be going down over the next couple of years and at a much faster pace than this has been anticipated. I mean, to give you an example from my bank here in Warsaw, we are currently finishing a new office building, or the headquarters of our bank. And the initial plan was that this headquarter will be able to absorb around 80% of the staff working in the headquarters. So there will be, call it 80% of hot desks being in this premises. Right now, this share has been considerably streamed down because of the assumption that more and more people will be working from home, or that even if people will still be coming to the office, they will be say working 2 or 3 days really from home, which will not necessitate this type of huge office spaces and so forth. And I think that this is quite common. Another thing is of course the kind of commercial real estate. Think about shopping malls. That again, I mean, maybe seeing downside trends in the next years to come if people do not come back to the big shopping malls, rather prefer to buy through the internet or to buy in smaller premises. A more nuanced picture, I think, in terms of warehousing logistics. Here, especially if we would take the view that supply chains will be done in a less efficient but more robust way, that companies will be also more willing to pay for inventories, for stockpiling and so forth. This market has upside potential in my opinion. And finally, housing. We could see a number of different trends, right? I mean, if starting again from this working from home, those people who can afford it and who would who can work from home may start to pose stronger demand for homes that are located in the suburbs and not necessarily in the city centers. So this kind of individual housing or standalone houses, demand for that may certainly increase, creating new production of those facilities, including the necessary infrastructure. If of course the kind of public servants or city mayors are thinking in the same way, that this is rather an opportunity than a threat, just to bring new connections, trains, trams, buses, and so forth. So that is perhaps likely to be happening. Maybe Stretch, can you comment on the possibility of another drop in oil prices? I mean, yeah. I mean, if my baseline is proving to be too optimistic, and we start to see some sort of renewed disappointment in terms of growth, oil prices will be dropping. I mean, irrespective of what we can say about the OPEC and about the decisions on supply, it is a still very much demand-driven market, or prices of oil are still very much reflecting demand conditions and demand expectations all around the world, and therefore, by chance or by nature, they are very close bound to the growth expectations and things people see in the leading indicators for economic activity moving forward. So if there is a double dip, if there is a disappointment in terms of global growth prospects, then yeah, I mean, oil prices could drop again. Probably not down to 20 barrels as we have seen that temporarily on the Brent, or even lower on the WTI, but still a couple of dollars or several dollars less compared to today is likely in this environment. And finally and lastly, I see one question: which country will benefit more, billion euro and recovery plan? Well, I think. Well, the numbers have been conveyed. That's still pretty much a kind of sort of discussion topic. But what I would perhaps highlight is that it is, of course, it is a function of the amount, but it is a question: what do you do with the money? What type of projects you will be spending this available funds, and how efficiently you can create multiplier effects on that. So I think beyond the kind of amount that countries will be getting at their disposal, another thing will be the efficiency of spending, and here probably some past experience of how these sort of projects have been done could be a guideline, but at the end of the day, we're gonna see it in few years time. So how efficient the spending is gonna be handled, is gonna be managed by the policymakers. I think that's all. I don't see any more questions.
Okay, thank you, Michal. I think that we are on time. So I would like to thank again BNP Paribas to being a partner of this event, and Michal for the presentation. And thank to all participants for participating. So wishing you a nice day and a weekend. And
thank you very much.
See you soon.
Thank you very much. See you.
Thank
Bye.
you.